In this video, you'll be learning about this topic.
I have a follow-up to that question. So stocks themselves can be uncorrelated, right? You have different industries, different sectors. So how much of the portfolio is typically thought of as, are stocks just stocks and that's how we should think of it? Or can you dig a little bit deeper into a stock portfolio and say, look, this is in itself a little bit more diversified because, banking isn't that correlated with utilities or whatever it might be?
That's a great observation. So that's true that if you think about what an equity is, it is a package of earnings from a particular business. And businesses have earnings that are driven by different factors. So you're right that there is diversification across different industry sectors. But the challenge is that when you invest in equities, you also have certain risk factors in common, namely economic risk. So all of those earnings tend to be better in a strong economy and they tend to be lower in a weak economy. So that is a common factor across all equities, no matter what sector you invest in. Similarly, interest rates can have an impact. So if you think about what an equity is, it's a present value of all of those earnings, and that's impacted by how you discount those earnings. And many companies utilize leverage as well, so they're very directly sensitive to the cost of leverage, which is the level of interest rates. So that those common factors tend to dominate the behavior of equity markets day to day. And so when you look across different sectors, they tend to be very correlated to one another. You don't usually find different equity sectors that have zero correlation just because of those common risk factors. Now, that said, you will benefit by having as much diversification as you can within your equity allocation. And it is important to think about equities that behave differently across different environments. So earnings that are different across different economic environments. And that's why we do utilize commodity producer equities in that way. But we are also honest with the fact that those are not zero correlated to stocks. They are probably 0.6 correlated to stocks. And so what we also hold is gold. And gold is pretty close to zero correlated with stocks. And so when you put the two together, you get a package of commodity exposures that are actually quite lowly correlated to the broader equity markets.
The one thing I would add is when you think about diversification, you really want to consider it during the worst of times, because that's when it's there to protect you during the worst periods. And if you think about the 2008s and the first quarter of this year in 2020, when you had a massive sell-off, just about every stock went down. And it's the real diversifiers like treasuries, and we'll get into this, and gold and inflation protected bonds like TIPS that go the other way. And so you've heard this saying of during a crisis, diversification doesn't work because all correlations go to one. It's true for a lot of these assets, but for many others, the correlation actually goes to -1. It actually does its best during the worst of times. And those are the diversifiers that are truly valuable. And so we'll talk about that a little bit later.
You mentioned something interesting there. You said that you're looking at commodities producers. Does that mean that instead of holding gold or oil directly, you might be holding Barrick's Gold or ExxonMobil?
We hold gold on a direct basis. So we invest in the physical metal. Whereas with the other commodities, we access them through the commodity producer equities. And we do that for a couple of reasons. Commodity producer equities, in our view, based on our research, have higher returns long-term than commodity futures. So some risk parity strategies utilize the futures. We think we're going to generate a higher return with the commodity producing equities. There's also, from a taxable investor perspective, some pretty significant tax advantages to utilizing the equities. So you can essentially get deferred long-term cap gains instead of realized income from the futures. That's a pretty big deal over time. And then we can build the portfolio in such a way that we can be cognizant of the equity risk we're picking up in the commodity equity exposure and either hedge that through the gold or hold a little bit less of that in the broader equity allocation we have. So that's how we adjust for that. But we found that in the context of this portfolio, the ETF that we're managing, that is a more efficient, higher returning way to get the commodity exposure.
The main thing with the ETF and what we're talking about here is built on this idea of risk parity, which is something that Dalio had coined, I believe. And the philosophy is essentially that all the bets that make up the portfolio are uncorrelated and that the risks kind of offset each other, or at least balance to a certain degree between the level of risk in each bet. Is that a good way to explain risk parity, or how do you guys think about it?
Yeah, why don't we start at a high level and work our way down just so that we all end in the same place. So you can think of it as like a traveler, right? Every portfolio sets on a journey to go from point A to point B, and hopefully point B is higher than point A. And these journeys go through peaks and valleys, and you can think of that as volatility, right? There's ups and downs. And the journey ends when the strategy is abandoned, and hopefully it's not at the trough. And so investors have a choice of what path they want to take from A to B. And we can divide it up into two. There's the traditional path, which I'll describe, and then there's the risk parity. Right? We can think of it as like an independent path. That's the path that managers like Ray Dalio follow because they think it's a better path, and better meaning less volatile way to get from point A to point B. The big risk of taking that route is abandoning it at the wrong time. And so you can ask, how would that be if it's a better path, if it's less volatile? And it's because it is the less traveled path. You ask somebody how they're doing, it's all about the market. And the market means the stock market, right? That's what's in the news, that's what's on TV, that's what's advertised. And so the focus is on that market, which is what Damien described as the traditional portfolio, which is dominated by the stock market. And so when you're on this less volatile path and you're looking over the ravine to the other side where the other investors are in that more volatile path, it's hard to hold on when you're focused on maybe the shorter term results or how others are doing. So that, I think that's a very important distinction here, is just make sure everybody's aware that we're talking about two different types of portfolios. And so let's go back to the traditional approach. It's understandable why that's the traditional approach and why it's made up the way it is. I think the way most people think about building a portfolio is they have two menu items. There is stocks and bonds. Stocks have higher return, higher risk. Bonds have lower return, lower risk. And so you own stocks for the return, you own bonds to control your risk. And you scale up or down between those two assets based on how much risk and return you're trying to target. So that's the way most people think about it. It's a very simple model. It's very convenient. But our view is there's actually a better menu available that leads to a better model. And essentially, there's a completely different framework. And the key, and now we're getting into what risk parity is, the key is understanding that asset class returns are by and large influenced by the economic environment. And there are assets that do well in different environments. So there are bad environments for stocks, but that same environment is actually good for other assets. And we're talking about growth and inflation, which we'll get into in a little bit more detail. And so rather than concentrating in one asset class, like the traditional 60-40 type portfolio that's dominated by what stocks do, we think you can balance across a diverse mix of asset classes to achieve a smoother ride. And so this recognition that the economic environment largely drives asset class returns is the first step in building a risk parity portfolio. The second step is matching the return and risk of each asset class. And basically what that means is you pick asset classes that do well in different environments, and then you structure each to have a similar return over the long run and similar risk. And when you put it all together, now you've got a portfolio that's much more diverse with a comparable return, actually a higher return than stocks, we think, over time. And that's effectively what risk parity is.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.